If you plan on buying a home with a conventional mortgage in 2024, which is actually the most common type of mortgage people are using to purchase homes right now, you'll want to save this video. I'm going to cover conventional loans from beginning to end and everything in between. I'm going to share a few tricks along the way that will save you money on down payments, closing costs, and even show you how to get a lower interest rate. So let's talk about conventional mortgages. They're mainly for buyers with higher credit scores. And the reason I say that is because they're very credit score driven unless you're a first-time home buyer. I'm comparing this to an FHA mortgage, for example, where credit scores are important, but not as important in determining what your interest rate and cost of mortgage insurance would be. On conventional mortgages, there are more credit tiers when qualifying, and therefore that comes into play even more so with the qualifying process and determining what the terms of your mortgage would be. Now, if you're a first-time home buyer, as I was starting to say, there are no adjustments based around your credit score. So someone with a 620 credit score, which by the way is the lowest credit score you can have when getting a conventional mortgage, would actually get the same interest rate as a buyer with an 800 credit score, assuming you're a first-time buyer, meaning you have not owned a home in the past 3 years, and your income is at or below 100% of the area median income for the home that you're purchasing. And you can check out your area median income online. I can share some links in the description to Fannie Mae's lookup for area median income. But you do not need to put 20% down on a conventional mortgage, which is a common myth that we see when it comes to conventional financing. As a first-time buyer, you can actually put as little as 3% down. If you're a non-first-time home buyer purchasing a primary residence, which means a home you're going to live in year-round, then you can put as little as 5% down on that property. So 20% is just a myth. You do not have to put 20% down if you're buying a primary residence using conventional financing. Now, conventional mortgages are backed by either Fannie Mae or Freddie Mac. And the guidelines are gonna be slightly different depending on what type of mortgage it is you're obtaining, whether it be going to Fannie Mae or going to Freddie Mac. And I'll get into more detail on that in just a few moments. Conventional mortgages are used to purchase either a primary residence, a second home, which is a home that you can use for vacations or you don't live in year round, or an investment property. An investment property is a property that you're using to make money on. It can be an Airbnb, it can be a long-term rental. Either way, that's an investment property, a property you are not planning to live in. Now, let's talk about down payment and closing costs. So I mentioned that there's 20% is just a myth. You can put as low as 3% down if you're a first-time home buyer. Well, the only other time you can put as little as 3% down on a conventional mortgage would be if you are eligible for either Fannie Mae's Home Ready program or Freddie Mac's Home Possible program. So if you were just listening, Fannie Mae and Freddie Mac back conventional mortgages, and it's a little bit different if you're getting a Fannie Mae conventional mortgage or a Freddie Mac conventional mortgage. But both of these entities offer programs that are not just for first-time home buyers, but do allow as low as 3% down on the purchase of a primary residence. However, if you've already looked in my description and gone to the area median lookup website, you will see there's an 80% area median income arrow. For, let's just say you put in your current address, it pulls up the income, look for the 80% arrow, and next to that, it's gonna say Home Ready income limit. That's because Home Ready and Home Possible as well, they both follow the same guidance, will allow you to put as low as 3% down on a primary residence, assuming your income is at 80% or less of the area median income for the home you are purchasing. And I wanna be clear on something with this. It's your qualifying income. So maybe your household income exceeds that amount, but if you don't need all of your household income to qualify for the mortgage and the income being used to qualify is 80% or less of the area median income, then you would be eligible for these programs. On top of them allowing a lower down payment, they also have lower interest rates, and if you're putting less than 20% down, which is likely if you're using those programs, they have a lower rate of mortgage insurance. So it's something that you definitely want to consider and definitely want to try to take advantage of, assuming you're eligible. Ask those questions of your lender when you're working through the process of getting pre-approved. Specifically ask about these programs. They might not just tell you about them. And maybe it's not because they're intentionally holding information from you. Not every lender has this information or knows it readily, and they're gonna have to look it up for you to see if you are eligible. If it's not a program offered by the lender you're working with, and you know you're eligible, you probably want to speak to another lender who can offer that to you. Now, as I mentioned, if you're not a first-time home buyer, you don't qualify for that program, you can put as low as 5% down on the purchase of a primary residence. As far as closing costs, they're going to be the same as any other type of loan. There's no additional costs because you're getting a conventional mortgage. It is what it is. Some other types of loans come with additional costs, such as FHA. An FHA loan has additional costs, and that's what's called an upfront mortgage insurance premium, which is 1.75% of the amount you're borrowing. With a conventional mortgage, you don't have that. So by additional costs, that's exactly what I mean. Nothing additional on top of any regular closing costs you'd incur with a traditional or any other type of mortgage. Now, as far as verification of the funds that you need, the documents that are needed for a conventional mortgage are rather simple. If you're a W-2 borrower, we're going to be looking at your pay stubs, your W-2s, your bank statements, your credit report, of course. Now, whether or not you're going Fannie Mae or Freddie Mac could change that as well. So let me give you an example. Let's just say you're self-employed. If you're self-employed and you've been in business for less than 5 years, typically you'll need 2 years of filed tax returns to qualify for a conventional mortgage. However, Fannie Mae will allow you to qualify with just 1 year of filed tax returns if when we run or your lender runs your loan through Fannie Mae's underwriting software, which is called Desktop Underwriter, if it comes back and says we only need to verify 1 year of income, assuming you have at least a full 12 months of income on your most recent filed tax return, well, then you only need 1 year of tax returns. Where Freddie Mac only allows that if you've been self-employed with the same business for 5 or more years. Now, Fannie Mae also just implemented that 5-year rule. So if you've been self-employed 5 or more years, same business, it's automatically only 1 year you need. However, the difference is if it's been less than 5 years, there's still a chance you might only need 1 year of tax returns with Fannie Mae versus Freddie Mac. And the benefit to needing only 1 year of taxes versus 2, especially if you were maybe a newer business, maybe your business was just established 2 years ago, so your first year you might have shown a loss or much less income than your second year. Well, by us being able to use your most recent year of income to qualify, your most recent tax returns, we're not going to have to average the 2 years together, because when you're self-employed, normally you need to average the most recent 2 years of tax returns together to get your income, which means you're going to show less income, assuming your older year is lower income than your more recent year. But by needing 1 year, it gives more income to work with, meaning you qualify for more. Now, as far as credit requirements are concerned, the minimum credit score for a conventional mortgage is 620. But like I said earlier on, the conventional mortgages are really more beneficial to those with a little better credit profiles, just because assuming you're not a first-time buyer, assuming you're not 100% area median income or below, or 80% area median income or below, the rate's going to be substantially higher if you have a 620 credit score on a conventional mortgage than if you were just to go and get an FHA mortgage, assuming you're buying a primary residence. FHA is not going to be as credit score driven, and therefore the rate will be more attractive, and the mortgage insurance you're going to be required to pay if you're putting less than 20% down will be less expensive as well. The sweet spot on conventional loans when it comes to credit score is really around a 680. So if you're below 680, I would really look at alternatives, as I said, such as an FHA mortgage. Now, if you're looking to buy the property as a second home or an investment, well, conventional is really your only option. So regardless of your credit score, you're going to be going with the conventional mortgage route. You really want to have a 2-year credit history. It's really preferable. It's not required. Ideally, you do want to have some credit history, so that way you have credit scores, because you cannot get a conventional mortgage with no credit score. So there are 3 credit bureaus that we pull. It's Experian, Equifax, and TransUnion, and a lender will take the middle of the 3 scores to use toward qualifying. So you need to have the scores to qualify. Where with FHA, for example, you can actually get a mortgage with no credit score. So just something to think about when you're looking at your mortgage options. Now, as far as credit events are concerned, we've gotten pretty far past 2008 to 2010 now, where we saw a lot of short sales and foreclosures and bankruptcies. But those things are still common, just not quite as common anymore. But there are certain waiting periods that you need to allow to pass before you can qualify for a conventional mortgage. Now, every type of mortgage has waiting periods. They just vary depending on the type of loan you're looking to obtain. But we're talking about conventional specifically right now. So let's just say you had a deed in lieu or a short sale. Deed in lieu is when you didn't allow your property to be foreclosed on, but instead you gave your property back to the bank. That's called a deed in lieu of foreclosure. Or you had a short sale, meaning that your bank agreed, your mortgage lender, you own another property, they allowed you to sell your property for less than what you owed on that property. That's a short sale. Let's say you owed 400, but maybe the property value was only 350 in the market, and the bank allowed you to sell your property for 350. So they took a loss of $50,000. Well, you did a short sale. You sold it for less than what was owed on it. If that's the case, then you have to wait 4 years before you can qualify for a conventional mortgage. Let's say you didn't go with one of those options. Unfortunately, you got into a position where you actually let your property go back to the bank, or it ended up getting sold by the court, and it was a foreclosure. Well, you'd have to wait 7 years from the date of the foreclosure sale. Now, here's where you want to be a little bit careful. You did have a foreclosure. The date you moved out of the property is not the date of your foreclosure. What lenders are looking at is the date of the foreclosure sale. So when the property actually went out of your name, back to the name of your banker, whomever it was that was the next person on title or entity on title, that is what a bank is looking at when counting the 7 years. So keep that in mind. I've had plenty of situations where I'll talk to someone and they'll tell me, oh yeah, that we had a foreclosure, it was 10 years ago. And we pull up the property address and it turns out that that property just sold 5 years ago. It was actually in their name without them even realizing. 5 additional years. Well, that waiting period started from when the sale date was, not when they thought it was, which was way before 5 years ago. So that's just one example, but it happens often, so you need to be careful. Now, if you had a bankruptcy, as an individual, there's 2 types of bankruptcies you can file, right? We're not talking about business bankruptcy, specifically individual or personal bankruptcy. So there's a Chapter 7 bankruptcy, which is where you discharged all of your debt. You essentially said, I'm not paying on any of this, I can't pay on any of this, and it was completely discharged. You didn't make any monthly payments. Well, you have to wait 4 years from the time of discharge to be able to qualify for a conventional mortgage. If you had a Chapter 13 bankruptcy, which means that you were on a payment plan and you made monthly payments to a trustee, well, you need to wait 2 years from the date of the discharge of that Chapter 13 bankruptcy. So it's half the waiting period. However, you might have been on a 5-year payment plan. So from the time you filed bankruptcy to the time that you actually were able to qualify for a conventional mortgage may actually be longer than it would have been had you filed a Chapter 7 bankruptcy and just waited the 4 years. Now, since we're talking about credit related items, let's talk a little about student loans, right? A lot of people, if not all people, have student loans. And for most, if you do have them, if you have government student loans, they just came out of forbearance, right? They were in forbearance because of COVID for a while. In October of 2023, those student loans came out, and now you're required to make payments again. But those payments can vary. You might be on an IBR or IDRP, which is income-driven repayment plan or income-based repayment plan, where your payments are extremely low because they're based on what you make. It doesn't matter what the balance on the loans are. You're actually making a payment. I just had one now. The borrower had about $60,000 in student loan debt, but their monthly payment was only $23. It's because they were on an income-driven repayment plan. We know that $23 is not going to pay that student loan off anytime soon, right? You owe 60 grand, you're not paying that thing off in your lifetime. You're not paying that off at $23 a month. However, a lender can use the income-driven repayment plan payment toward qualifying for your mortgage. And we talked about Fannie Mae and Freddie Mac having slightly different guidelines earlier. Well, it comes into play again on the student loans. So if you have a student loan where your income-driven repayment plan payment is $0, which there are income-driven repayment plan payments that are only $0. If it's $0 per month on a Fannie Mae conventional mortgage, we can actually use, or any lender for that matter, can use 0 as your student loan payment. If you're getting a Freddie Mac mortgage, that student loan payment on your income-driven repayment plan can be considered as long as it's at least $1. If it's 0, then it doesn't matter. We have to count a payment. So it has to be at least $1 on an income-driven repayment plan for Freddie Mac. Now, let's just say you're not on an income-driven repayment plan. Let's say you're in deferment, or you are still on forbearance for some reason. Well, there are specific calculations that lenders use depending on the agency that we're using, Fannie Mae or Freddie Mac, to determine a minimum payment on your student loans. For Fannie Mae, we use 1% of your student loan balance as the minimum payment. For Freddie Mac, it's 0.5% of your student loan balance as the minimum payment. So up until this point, you might have been thinking to yourself, why would I go to Fannie Mae or Freddie Mac? What would be the difference if it's a conventional mortgage? Well, there you go. Your student loans could be a huge reason why we would use a Freddie Mac backed mortgage versus a Fannie Mae backed mortgage, just for one example. Now, we talked about how the minimum payments would be considered, and that's where that comes into play, because we're just talking about payments right now. The difference is in your debt to income ratio. Now, if you want to learn what a debt to income ratio is and how lenders calculate it and where it comes into play with qualifying for a mortgage, make sure to check out my video on debt to income ratios, or DTI. I get into detail on how it's calculated, even give an example of a calculation of a debt to income ratio. But that's where these payments on your student loans come into play, in calculating your debt to income ratio, because in turn, that will determine what you qualify for. Now, the interest rates on conventional mortgage are going to vary. We talked about based on credit score, but they also vary based on your down payment. The lower your down payment, typically the higher the interest rate on that mortgage. If you are doing a lower down payment, by lower down payment, I'm saying anything less than 20%, you're going to be required to pay something called mortgage insurance, or PMI, private mortgage insurance. This is insurance that protects the lender for that 20% you're not putting down in the case of a foreclosure. Now, the mortgage insurance on a conventional loan eventually goes away. Unlike an FHA mortgage, where regardless of your down payment, you'd have that mortgage insurance for life. Or actually, I'd say if you put 10% or more down FHA, it does go away after 12 years, but no one's getting an FHA mortgage putting down 10%. If you have 10%, you're typically going conventional and putting that money down there. The mortgage insurance will fall off once you have 22% equity in the property. So essentially 78% of your original purchase price of the property. The other way to get rid of your mortgage insurance faster is if you've made payments for 2 years, there are cases where you can actually have a new appraisal done on the property by the lender for the purpose of removing the mortgage insurance. So if they determine that you have enough equity based on the appreciation in the property's value, then they can remove the mortgage insurance at that point in time. Also, if you buy a property and make improvements to it and you had a conventional mortgage, you can also ask the lender to reappraise the property based on those improvements, such as maybe you added a pool, a new roof, hurricane impact windows, a new kitchen, bathrooms, whatever it is, something that added true value where you feel now you have enough equity based on the appreciated value or increased value of the home. You can request that the property value be reassessed to determine that you have at least 20% equity in the property to have that mortgage insurance removed. Now, mortgage insurance on conventional mortgages varies depending on your down payment percentage, less than 20%, of course, but it works in 5% increments. So 5% down, 10% down, 15% down, and your credit score. The lower your credit score, the higher the mortgage insurance is going to be, which is why I said early on, if you have better credit, you're going to want to go conventional. If you have worse credit, let's call it 680 or below, FHA is a better option. And that's because FHA loans, their mortgage insurance cost is identical from one borrower to the next as far as a percentage of the loan amount is concerned. It doesn't vary based on credit score. Where on conventional loans, it can vary substantially. You can be paying 0.25% in mortgage insurance, or you can be paying 3% in mortgage insurance. So that's something you want to consider as well when looking at your options. Now, as far as the property types are concerned and what you plan to do as far as the occupancy on those properties is, well, that's going to require different down payments. So on a primary residence, we talked about if you're a first-time home buyer, haven't owned a home in the last 3 years, you can do 3% down. If you're not a first-time home buyer, you qualify for either Home Ready or Home Possible. You also can put 3% down if you're planning to live in a property as a primary residence. If you're not a first-time home buyer, you don't qualify for those two programs. Your minimum down is 5% as a primary residence. Now, if you're buying as a second home, your minimum down payment is 10%. And if you're buying as an investment property, your minimum down payment is 15%. Now, there are loan limits for conventional mortgages, as there are with all types of mortgages, whether it be FHA, USDA, VA. The current loan limit in South Florida and most of Florida, as a matter of fact, it's just increased to just over $766,000. It was over a $40,000 increase from the maximum conventional loan amount allowed in 2022. So that's a huge jump. And you want to take advantage of that because it does allow for the lower down payments. Anything above that loan amount is considered jumbo. So when you get into jumbo territory, the guidelines become more strict as far as credit score, but also as far as the down payment is concerned. So you really want to be familiar with this loan limit when you're looking at properties, assuming you're trying to go with a lower down payment option and utilize conventional financing. Now, when you're getting a conventional mortgage and you've gone under contract on a property, you're going to need an appraisal. So what's nice about a conventional appraisal over an FHA appraisal, for example, is that conventional appraisals aren't really going to focus on any sort of health and safety related issues there might be with the property. For example, if you're getting an FHA mortgage on a home built prior to 1978 and there's chipped paint on the exterior of that home, well, that home's gonna have to be repainted in those areas. And the reason being is lead-based paint was prominent prior to 1978. However, on a conventional loan, if that same chip paint was there, that would not be a requirement, right? So it's a little bit more lax on the appraisal standards. Another benefit of conventional is if you're putting 20% or more down and you're buying a second home or a primary residence, there's a chance you might not even need to have an appraisal done on the property. These are called appraisal waivers, and that's determined by your lender when you put a specific property address into the underwriting software used by both Fannie Mae and Freddie Mac, and they result in findings that tell you there's no appraisal required. And a benefit of not needing an appraisal is it might make your offer more attractive to a seller because they don't have to worry about the property potentially underappraising if the appraisal is done. And then you have to renegotiate that contract essentially from the start and try to hold it together. So by being able to submit an offer where an appraisal is not required, it certainly makes it more attractive to the seller of that property and their agent, and potentially allows you to get a property under contract where you may not have been able to using another type of mortgage. So to touch briefly on debt to income ratio, I just want to get back to that real quick. Depending on the type of mortgage you're obtaining, whether it be conventional, VA, FHA, is going to affect the maximum debt to income ratio allowed. So in conventional specifically, the maximum debt to income ratio is going to be 50%. Now, Freddie Mac, right, is different than Fannie Mae. It does go to 50%, but the big difference between Freddie Mac and Fannie Mae is that Freddie Mac actually rounds down to the nearest whole number or up to the nearest whole number. So technically, if your debt to income ratio is 50.4% and we're using Freddie Mac, that's considered a 50% and you'd qualify. Where with Fannie Mae, 50% is truly 50%. You go to 50.01, that is not going to work. So you have to be at 50% or below Fannie Mae, technically 50.4% or below Freddie Mac. So I just wanted to bring that to your attention because I think that's important for you to know. Now, let's talk a little about some costs. We talked about there being no additional costs on conventional loans like there are with FHA or VA loans, but you're still going to have costs as far as closing costs are concerned, just like everyone does, right? Those are your government charges, your title charges, your lender charges. So you can still get credits or seller concessions. And I did a video on seller concessions specifically. So if you want to know more about those, what they are, how they work, and how to get them, please make sure to subscribe, watch that video. However, here's just a basic overview of what's allowed. So a seller concession is a credit from a seller to go toward your closing costs. Depending on how much money you're putting down and how you plan to occupy the property is going to determine what the maximum seller credit you're allowed to get would be using your conventional mortgage. So you're buying a primary home using a conventional mortgage, putting down 10% or less, the maximum seller credit or concession that you can get is 3%. If you're putting down 10% up to 25% on a primary residence or second home, you can get up to 6% as a seller credit on that property. Now, if your down payment is 25% or more on a primary residence or second home, you can actually get as much as 9% as a seller credit. Where it changes is if you're buying a property as an investment, which we talked about needing a minimum down payment of 15%, your maximum seller credit, regardless of down payment, 15% or more, is going to be 2%. An unspoken benefit of a conventional mortgage is really the seller and the seller's agent perception of the loans. For whatever reason, conventional mortgages are the gold standard of mortgages when you're submitting offers on properties. I don't know why it is, because most lenders can close an FHA, VA, or conventional in the same amount of time, and it really is all the same in the eyes of the lender. However, in the eyes of a seller and their realtor, conventional is the way to go. So let's just say you've closed on your home and you have your conventional mortgage now. You close at a high interest rate and you want to take advantage of a refinance. A refinance is when you pay off your existing mortgage with a new mortgage. And there's different reasons why you'd refinance. Some are to get a lower interest rate. Some are to change the term, meaning maybe at a 30-year, you want to go a 20-year or a 15-year. Sometimes you want to pull cash out of your property, pull the equity out, right? Actually receive money. That's a benefit of being a homeowner. Your property goes up in value. You're paying down your mortgage balance. You have equity in your property. That's your money. The way you get it out is you do a refinance. You pay off your existing mortgage. You can pull some money out if you wanted to. With conventional mortgages, there's no sort of streamlined process as I've talked about when it comes to FHA and VA loans. However, all that needs to happen is you go through the approval process again. You provide your income documents, your asset documents, a new credit report is pulled, potentially a new appraisal would be done. The benefit of doing a new appraisal in the instance of wanting to pull cash out is it gives you more value to work off of, because more than likely your property is worth more now than what it was worth when you closed on it. So you go back through that income credit and asset underwriting process in order to get reapproved for the mortgage. But you close just the same way you did on the previous mortgage. Your old loan is paid off and your new mortgage takes over there. Now, you don't always have to start over at 30 years. We get asked that pretty often. If you have a 30-year mortgage, you're 2 years into it, you may not necessarily want to start over again at year one of the 30 years. And you can actually have a custom mortgage date range on a conventional. You can start at 28 years in that case. That means you're not losing any of the time you've paid into it, and you're not paying additional interest because you've started it all over again. So you've now determined that a conventional mortgage is the right route for you. So how do you apply for a conventional mortgage? Well, the first thing that you're going to want to do is you're going to want to find the right lender for you. Is it going to be a credit union, a broker, a banker direct lender? Where can you find these lenders? Well, what I recommend doing is looking online, right? You're probably watching this online right now. So it tells me you know how to use a computer. Just Google conventional mortgage lender by me, right? You can go on Zillow.com and you can actually search mortgage lenders on Zillow. Read past reviews, see what other clients who have worked with that lender have to say about their experience. I wouldn't recommend going directly to that lender's website at first, because any reviews on there are the reviews that that lender wants you to see. You want to read the reviews on a site that the lender does not control. So on Google or on Zillow, like I said, you're going to read true reviews from real clients who actually worked with those lenders. And once you've gone and you've done those reviews, then you can decide who you want to reach out to. Just about every bank, credit union, mortgage broker, direct lender, whomever it is, handles conventional financing. It's not a specialty of any sort, but you will get a different experience with each of those people. So find who's right for you. Reach out to them. Even shop lenders, I recommend that. You might want to reach out to 3 or 4 different lenders. Feel them out. What you're gonna see is you're gonna get a different experience each time. The conversations will be different. The rates will be different. The costs will be different. Find who's right for you and apply with that lender. If you felt the information in this video is helpful with your home buying journey, make sure to comment below. I do reply to 100% of the comments on my page, and subscribe for more videos just like this one.